Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We've got Amy Polvado with us today. So, Amy, welcome.
Hey, thank you for having me. It's great to be here.
Yeah, good to have you. So, do us a favor and tell us a little bit about yourself and what got you into real estate.
Okay, so I am from Austin, Texas. I grew up actually in Texas, and I am a third generation entrepreneur. My granddad had a glass company. He started in 1960, and my dad took it over in 1974 after he graduated from an A&M. And he had gone to work for some construction companies and came back home to help with the glass company. And he kind of raised the stakes at the level of they went from a very home and auto glass to very commercial construction, because that's kind of what my dad had specialized in at A&M.
Yep.
And so I just remember riding around in the back of a truck, and I was with my dad. Well, after I graduated from Purdue, I did a little stint in Fortune 500 land, but didn't stay there long. And then I started a construction company in 2003. So I was a commercial contractor, and we were building stores kind of all over the place. And by 2014, we were in 16 states performing projects for about 5 different retail brands. And along that journey in 2008, started real estate investing, because every GC thinks they can be a house flipper. They just all kind of do. And so we started flipping houses in 2008, and then got into single family rentals. And then we got in 2010, got into multifamily. And then by 2015, we retired from construction for other people and became a developer and was buying apartment, mostly multifamily. And then I got divorced in 2017, but just kept going. I had a private equity firm, so I was syndicating deals and putting deals together and chasing deals and chasing money. And I did that for a long time. And by 21, I was in 4 states doing developments and projects. And I was in Colorado, Arizona, Florida, and Texas, doing projects all over the place. And then I had started a tech company, because I, being a longtime owner, realized that I needed a software solution, and it didn't exist, and it was driving me nuts. So I'm like, all right, I'll do that too. So I started a tech company also. So that's kind of been my journey. Been doing it for a long time, like 21 years in commercial real estate, starting as a GC. And, I'm still in the real estate game. I'm just on the tech side now. So
Awesome. Well, let's kind of dissect some of those things. I mean, I'm giddy over here thinking, man, there's so many things that we can talk about. So real quick, let's hit, moving into flipping. I mean, what really I think caught my attention was 2008, which was probably a really good time,
Oh yeah.
but challenging as well. So what
Oh
were
yes.
the
Yes.
challenges you had? I mean, because 2008, the market had crashed,
Yep.
property values were sliding,
Yep.
and lending was extremely difficult.
Yeah.
So, talk about some of the challenges and how you navigated that.
It was interesting. I was at my oldest son's baseball practice, and I was bored. So I
Mhm.
walked around the neighborhood, and I found this house that looked like it was empty. Nobody was living there. And I reached out to, you look up the county tax website and you find out who the owner is. And I called them and I said, hey, are you interested in selling your house? And it was at a really cool area. And they said yes. I bought that house for $33,000. And
Wow.
I know it's amazing to, it hasn't been that long. That was like 16 years ago, but that's
Yeah.
what the prices were at then. I mean,
Mhm.
it was crazy town. And so I bought that house for 33,000, and I was a typical GC, man. I mean,
Mhm.
like, we way overdid everything.
Mhm.
Like
Yeah.
we made the house too nice.
Mhm.
Like, we tried to rent it first.
Yep.
And it wasn't that it was that we overspent, because we're just super resourceful. We had materials from other jobs, and we had all
Mhm.
these other different things. So they had granite countertops, and it had
Mhm.
all this really nice tile in it, and had all these really nice floors in it. And it was just too nice, and nobody would rent it.
Yeah. Wow. Yeah.
So then we ended up having to sell it, and because we
Mhm.
weren't planning on selling, because we didn't
Mhm.
think that anybody could sell. Like, this is '08, right?
Yeah.
This it sucked.
Yeah. People were getting foreclosed on. They
Yeah.
weren't. Yeah, they weren't
Yeah.
buying at that point.
They weren't
Yeah.
buying at that point. So we just planned on renting it, and then we couldn't rent it because we just shot ourselves in the foot.
Hmm.
And then, so we got very lucky. We had this realtor that we found in the local area, and she just knew everybody. And that lady is awesome. And she just retired, by the way. She's been a realtor for like 40, 50 years now. But back then she had been a realtor for a long time. And it was actually it's actually a nice story because it was to somebody who had ended up selling it for $85,000. So he bought it for 33. We put
Yeah.
up way too much into it. We ended up breaking even. Like, we no joke. We were so stupid with this
Yeah.
house. But we ended up breaking even after we sold it for 85. I think we
Hmm.
made $1,000, but I just call it breaking
Yeah.
even. And she found somebody who was coming into work for the police department,
Hmm.
and that he was able to get a loan because he worked for the police department, and he put a lot of money down cash.
Yeah.
So that was the only way we could have sold that house, like no joke, because they had favorable financing for first responders. And that was
Mhm.
it. I mean, that was the only way we could have done it. And we got very lucky on that one. Very, very lucky. But then the
Yeah.
market started to turn right after
Mhm.
that, right? And we kept buying single families and bought a ton of them, and we kept them as rentals. I mean, I bought in Austin, Texas, bought one
Mhm.
for 48,000, one for
Mhm.
53,000, one for
Wow.
54,000. I mean, less than 60K. We had 10 houses like that. And
Yeah.
then we started using those as kind of like piecemeal to, scale, right?
Mhm.
So, and then when we first bought our first multifamily, it was in 2015. We had invested as an LP in some other deals and
Yep.
done some multifamily investing. But then when we bought our very first one, we took four of the houses that we had owned from 2010,
Mhm.
2009, 2010, and had just such huge equity gains in those houses that we 1031 the profits of four of them
Yeah.
into the down payment for the multifamily, the 40 units that we bought. We had profits from four houses. We had profits of $225,000, which
Mhm.
we used to buy a 40 unit in College Station, Texas, is where
Okay.
we bought. So
Wow.
yeah. So, and then and then I turned and flipped that. So we turned that $225,000
Mhm.
into $800,000 when we sold that a couple years
Mhm.
later. Right. So
Awesome.
it allowed us to scale. But
Yeah.
yeah, it was interesting for sure.
Yeah, and I mean, so fortunate. I mean, you're in Austin, which from probably 2010 to 2020 is
Yes.
probably the belle of the ball as far as,
Yeah.
real estate appreciation and everything else. So extremely fortunate to get in when you did. And maybe not fortunate. I'm guessing you saw the real estate crash and said, game on. Now's the time to
Yeah.
go. So
Yeah.
I guess it's not exactly luck, but good on you guys for recognizing the opportunity and jumping on it. Let's talk about kind of going into that multifamily transition. You established a pretty good track record with
Mhm.
your general construction, general contracting company, with
Yep.
your single family. What were some of the differences and some of the challenges you had moving from there into multifamily, and then later on into the syndication of multifamily?
The very first multifamily we did it was a syndicate. So it was a
Mhm.
group of us that got together in 2010 and went and bought a 42 unit in
Yep.
Austin. And we bought that sucker for 38,000 a door. It was amazing. It was a foreclosure. And I can still remember that sponsor. So we were the general contractor on that job, and we were
Mhm.
also an LP in the deal. And there was a group of about 12 of us that got together and went and bought it. It was great. It was a great experience. And since I was the general contractor, we were there like day one. We were doing demos. So I happened to be there. So I would lease, I was a real estate. I was like, hey, Spun, do you care? I'm gonna lease this. Somebody showed up and I'm gonna lease them a unit. I happened to be there. So it was a different kind of syndicate. It wasn't like the normal one. It was a first time syndication for all of us. And this was a group of us that got together, no joke. We got together. We all wanted to be in real estate investing. And Terry would host us over at his house. And there was a group of us that would get together once a month and we would just underwrite deals.
Mhm.
And then we would pick everybody's apart. Like it was like
Yeah.
Socratic method. Someone come up, show a thing, and then we'll all learn from one another because we're all like picking apart their underwriting. And they would
Mhm.
just take a deal that already closed, or it wasn't like
Yeah.
an active deal or anything. And we would just underwrite it. right? And
Mhm.
that's how we learned. And somebody goes, what did you think about this? And this is what's happening here. And so it was fabulous. And so I will tell you, out of that group of 10,
Mhm.
probably 6 or 7 of them became sponsors later
Yeah.
because they all went, and that we just kind of did that. So when we got into multifamily, it was really, we
Mhm.
learned, obviously how to marketing and how to lease and how do you manage the onslaught. You learn the game between the first and the fifth. Just don't bother your poor property manager. They're in like they're just slammed, like, so don't try to get reports out of them. Don't, I mean, you're
Mhm.
just busy, and we
Yeah.
all property managed our own stuff, right? So, but in an apartment complex, going from like 7 houses, 8 houses to a 42 unit is like exponentially crazier. And
Yeah.
you're trying to put in rents and everybody forgets about their work orders until they turn their rent check into you. And
Mhm.
you just have all this stuff that happens all in the beginning of the month and towards
Yeah.
the end of the month, right? So in the middle of the month, yeah, you can bug them. But in the
Yeah.
beginning and the end of the month, forget it. Like
Yeah.
they're busy doing stuff. But
Yeah.
so it
Yeah.
was
Collecting rents and
yeah.
inputting, yeah, all that fun
Oh
stuff.
yeah. And
Yeah.
doing the billing and doing all that other stuff that you have to do all the time. Yeah. So it was understanding those cycles is kind of
Yeah.
one of the things we really learned. And then, and obviously you're handling more evictions. There's more transactional things that you're
Mhm.
doing when you're going from
Yeah.
single family to multifamily. Someone told us to kind of property manage it ourselves because we needed to learn it. And I give that advice to people. It's like you need even if you're property managing single families, it's not the same.
Yeah.
Don't, yeah, it's completely different, and understanding what you need to take in, because now you've got commercial inspections, like you got your annual fire inspection, and you got all these other different things you have to worry about and maintain and keep up with, and code review and like all these other things that are going to hit
Mhm.
you from left and right that you need to learn how to take care of. So if you later in life want a third party property manager, you know exactly what the hell they're talking about, and you know
Yeah.
what to advise them on. Yeah, for sure. Yeah.
Yeah, yeah. I mean, good stuff there. And there are a lot of similarities to how I started. I mean, going back to that group where you underwrote, that's exactly what I started doing. We formed a group. We were, throwing properties out, underwriting out together. And incidentally, that's how my first partnership formed, was from people in that group. And, we found a deal that we liked and we're like, let's partner on this together, and
Yeah.
I think that
Exactly.
there's a lot of goodness there as well.
Yeah.
And then I had a handful of single family. Actually, everybody in that first partnership I formed, or we formed, had a bunch of single family. And you're right. It was we may have been a little bit, know, arrogant, I
Yeah,
guess,
you
thinking,
are.
oh,
You are.
yeah, we
So I can do
yeah,
this. This is easy. It's no problem.
yeah.
Whatever.
Yeah, we've got like we had like 50 single family homes between the four of us, and we purchased a 55 unit apartment and thinking, oh, we got this, and oh my goodness. Talk about a little bit of a rude awakening. I think yeah, what you were explaining, I was, laughing on the inside thinking, oh my gosh, that's exactly what we experienced. But
Yeah. For sure.
well, really cool, cool, cool. So let's kind of go with the same progression. Multifamily a little different. How did that your multifamily progress, and then lead us into kind of the next transition to prop tech?
So I just scaled it over
Mhm.
time. I was an LP investor for a while and I became a sponsor, and then I was a leading sponsoring deals. And then and then I was doing a lot of that through syndications. And then eventually I had a fund. And so
Mhm.
I was using a fund to lead a lot of our deal acquisition. So I scaled, I think I scaled, I tell those people I scaled faster once I kicked out my ex-husband, and then I could actually just, no offense, but yeah, he's
Yep.
whatever. But but I did. I scaled pretty
Mhm.
quickly, and it could have been just the sign of the times. I got divorced in 2016, so it was that heyday of syndications to funds, and it was a great economic time to go buy a
Yeah.
lot of real estate, right? Except for when
Mhm.
COVID hit. So
Yeah.
yeah,
I mean, COVID had challenges, but it also brought opportunities as well.
it
I
did.
mean, the stimulus packages that the government
Mhm.
put in, I mean, 2021, 2022, the appreciation we saw in those years, I don't
I
think we're going
know.
to see that again for a
Yeah.
long, long time. But I mean, yeah, it's like things fell off a cliff for a couple of months, and then when they came back, they were roaring. But
Yeah. It was a crazy time and it was a wild ride. And yeah, and kind of chasing all that stuff. And then because I started real estate investing in '08, obviously I understand the real estate cycles, and when they started raising interest rates, I was like, all right, pause, hit the pause button,
Mhm.
stop all the developments that I had that were just where I was keeping architects and engineers busy. I just stopped them. He said he was going to kill the beast, and it was not going to take, 2 interest rate hikes to do that. Like, we knew that it was going to take a lot. I mean, we had pumped so much money into the money supply with all the stimulus payments. Of course, what's
Mhm.
going to happen? You're going to cause inflation, because now money,
Yeah.
it's just economics 101. And so if you do that, then you have to kill the beast. And so they had to do two things. They had to tighten the money supply, and they also had to raise the interest rates. And who is the most, interest rate sensitive environment? Real estate. I mean,
Yeah.
of course, we
Yeah.
were going to go into a recession. So,
Mhm.
like, this was, I was always shocked by the people that were like, I can't believe this is happening. Okay, I'm
Yeah.
sorry. He told you what he was going to do
Mhm.
before he did it, and then he did it. So, what do
Yeah.
you think was going to happen? Like, I don't know why anybody was shocked by this. Like, and there was a lot of people
Mhm.
with a lot of money they did the same thing I did. They hit the pause button. And they
Mhm.
just said, we're just going to hang tight on our money. We'll stick it in
Yeah.
bonds, make our 4 or 5% or whatever we're going to make. And then we'll just wait for this
Yeah.
onslaught that's about to happen. You know?
Yeah, that is exactly what happened to a lot of people. And I think if there was a mistake that a lot of people made is, and I remember a couple of years ago looking at, hey, the Fed's going to start raising rates. I don't think anybody anticipated it was going to get to 5.5% or 5.25%, I think is where we're at. I think people were expecting it to be short-lived
Right.
and not as extreme. But I mean, Jerome Powell, he's done exactly what he said he's going to do, the
Yeah.
entire time. So I think one lesson is when he speaks and he says what he's going to do, listen, I mean, that's
Yeah, exactly. Yeah.
yeah. So
Yeah, no, for sure. But it was almost free
mhm.
money. I mean, we got
Yeah,
so low that there was no way that was ever going to sustain. I mean, I've been investing since '08, right? So
yeah,
normal 5% is normal for
yeah.
loan rates. I mean, anywhere between 5 and 7, that is a normal average yield. Like,
Mhm.
on a
Yeah.
loan, you're gonna have to pay. Like, I can't. And so everybody was like screaming because it got to 5. And I'm like, that's what I was paying like 6 years ago.
Mhm.
But the prices were obviously a lot less, and they had
Yeah.
adjusted. But we had this stubbornness at the pricing that it
Mhm.
doesn't make sense. And so it's like, and there's such pressure to get it to come down. And I mean, eventually it will. We're
Yeah.
starting to start seeing some of those like half price real estate people buying stuff that are going to foreclosure. That's starting to
Yeah.
happen now in different asset classes. But yeah, no, it was interesting. So in 22, 23, we had a redevelopment going on. I got caught in the middle of that, and then I got out of that deal. And then I still have some deals. I have one in Houston that I mean, we're gonna have to ride it out. I mean, it's gonna be a great asset. It's just not a great asset right now, right? I mean, it's caught, and we had a variable rate debt that we had the cap, and we hit our cap pretty quickly.
Mhm.
And now we're paying that. They're making you pay that hedge on your cap, and that's
Yeah.
expensive as hell. And our insurance has tripled, and the expenses, everything. That's what everybody's caught up in right now. It's like
Mhm.
your expenses have gone to hell. You're especially on your insurance, especially on your payroll. And then you've got to buy that stupid hedge because you're in a variable rate loan, even though it's at its cap. It doesn't really matter, but you have to pay for it. And so those prices are starting to come down a little bit, but because now that it's kind of leveled off, but
Yeah.
it's insurance that's really killing people right now, especially in
Oh yeah.
multifamily. It's just
Oh yeah.
wrong.
Yeah, especially in the coastal areas, or anywhere prone to natural disasters. I
Yeah.
think coastal areas are Gulf Coast, East Coast, where you've got the
Yep.
hurricanes rolling through.
Hmm.
I mean, yeah, we've seen insurance prices double and triple
Yep.
in certain areas too.
And in hurricane season too. So that's a lesson learned. If you're going to buy something on the coast, don't buy it during hurricane season.
Yeah.
Like, skip that
June to
June to
November.
October. Like, go
Yeah.
buy it in December. Because you'll get
Yeah.
it at least
Yeah.
for a year, you're going to get a better premium.
We had one property. Here's something interesting with the insurance. This is a Houston property in Baytown. We did a new Freddie Mac loan on
Yeah.
this one, and we bought this one about a year and a half ago. And what was interesting is the insurance companies had changed so dramatically in a short period of time that, you know, it was a Freddie Mac loan, and they said, hey, these are the things your insurance has to, you know, your minimum insurance requirements.
Yeah.
And none of the insurance companies were meeting Freddie
Good.
Mac's minimum requirements, you know, and it
Yeah.
was just like, you know, we had to try to negotiate with Freddie Mac and say,
Yep.
look, we've gone out to a dozen different carriers. Nobody will
Well,
write us a policy to your standards. And we had to get Freddie to come down on their standards a little bit. But I mean, just talk about what's happened. I mean, the insurance company changed so quickly because of all the payouts that, you know, it was just like, hey, Freddie, you guys need to change too, you know, because
yeah.
but
Yeah, I mean, that's basically what drives
yeah,
the insurance cost is the lender requirements. They require all these stupid riders and specialty
yeah.
insurances and this, that, and the other. And yeah, I mean, you know, with same problem, we had one in Houston, and what they were requiring us to do was stupid. They basically we had to get a rider on our insurance to take it was like a specialty insurance that if like say a 1970s, one of our things burnt down, it was a 1970s asset, that we had to bring everything back up to code.
Mhm.
And I was just like, first of all, they're not going to do that to you, number one. I go, but if they did do it, it's a part of a construction loan. Why do I have to insure it? Like, I don't understand why you're making me insure this, right? And it's been hundreds of thousands of dollars. My riders were just as much as my PNC insurance. Like, it
Mhm.
was so dumb. I was
Yeah.
just like, ah,
Oh,
yeah.
speaking of, I mean, dumb things insurance companies do. We've got a downtown property, Salt Lake City. There's like no kids in the apartment, and they wanted us to retrofit all of the windows with child safety devices. You know, it was going to be like $600 per unit to retrofit every single window, you know, and I'm scratching my head, and I'm, you know, fortunately we were able to get the insurance company to see some common sense. You know, we had our property manager go through and say, okay, how many units have kids? You know, it was the answer, you know, 3 units have kids. And the insurance company wanted us to do it to all 50 units. It's just like, I'm not
Mhm.
going to pay $30,000, you know,
Yeah.
to retrofit units when we have 3 units with kids. But yeah, we were able to talk with the insurance company and say, okay, can we dial this down a little bit? And they ended up giving us, you know, what their exact requirements were. And we ended up having to, I think 12 total windows is all we had to do, you know. But
Yeah.
you know, if you look at what the insurance company starts out with, they're like retrofit every single window in the apartment. You know, it's like, oh,
Yeah,
come
but
on,
it's
guys.
like a game of telephone. You remember the game of telephone where
Mhm.
someone would say something.
Yeah.
So it goes from the insurance underwriter or the person goes to the insurance person, and then it goes to your broker who ends up telling it to you. And then
Yes.
you need to talk to the person at the beginning to
Mhm.
negotiate, right? But you have to fight through all of that
Yes.
to get there. And the person at the beginning might not have said that, but it ends up being that because that's what your broker heard.
Yeah, and that's exactly what this was. And I had to say, what is the exact requirement? And when we got
Yeah.
the exact requirement, that's where we went back through and we were just like, okay, according to this requirement, 12 windows is all we have to do, you know.
Yeah.
And if you want to send somebody out to inspect, by all means do it, you
Yeah.
know. But
Yeah. Yeah.
yeah,
No,
insurance crazy. It's one
I
of the
know.
painful parts of one other real quick insurance company, and then we'll talk about PropTech. But this just
Mhm.
happened 2 days ago. We get a quote from our property manager on tree trimming, you know, and we didn't ask for a quote on tree trimming. You know, it's just like we're scratching our head. This is a brand new acquisition.
Huh.
And he says, oh, your insurance rep, when they came out to do the inspection last week, told us that we had to do it, you know. And it's
Oh,
just like, okay, you know, so now we're trying to kind of dig back again and figure out, okay, what exactly is the requirement? You know, I'm not going to spend $20,000, you know, trimming every tree on the property. But yeah, it's one of these things where you got to just dial in and figure out, okay, what is your requirement, and you know, figure out how to satisfy it. But
yeah. And
all right,
there's a lot of people that'll just take that as rote and then just go do it and never bother to ask. I mean, but you have to. I mean, I was a general contractor and I was in 16 states at one point. So I was in hundreds of municipalities building projects, right?
yeah,
I dealt with those people all the time. I'd be like, BS. And I'd go back and talk to the building department. I'm like, no, I can't do that. Here, let's do that. You can always negotiate anything. You can
yeah,
talk to the insurance company. You can talk to your lender. You can talk to when you get a code enforcement thing, you can always
hmm
negotiate. But a lot of people will just, if we're talking about, new people, they'll just get that and go, oh no, now we have to spend
Oh
$50,000.
crap. Yeah.
Oh crap. And so, but yeah, I mean, just know that you can negotiate. And then sometimes you can't. Sometimes they're going to stick it to you, and you just have to deal with it at that when it gets there. But at least ask,
Yeah.
ask first.
Yeah. Don't take every, I mean, when you get those big ask, you're just like, tree trimming? Come on. Yeah,
Yeah.
I know the trees need to be trimmed, but anyway. Well, awesome. Well, let's talk about, your next transition into prop tech. What prompted that? And then let's talk about, what services you guys offer. And I understand you told me what it was at the beginning, president of a council or something like
Yeah.
that, some fancy schmancy title, but
It's a
tell us about
fancy,
that too.
yeah, yeah. So I'm the chair of the US Proptech Council. So
Okay.
we define PropTech as any technology that serves the real estate industry. The council is the trade association for the real estate technology industry in the US. We have 850 members, and it's real estate companies, and it's PropTech companies, and it's investors in PropTech, and it's also universities. We have a whole university program also.
Yeah.
So that's what the PropTech Council is. I
Okay.
started my PropTech company because when I was scaling,
Mhm.
when I had because when I originally started in multifamily investing, I was vertically integrated. We did everything. I was a property manager. I hired everybody on site. We did all of that, right? When I
Yeah.
was trying to scale, I realized that I just couldn't do that model. There was just,
Mhm.
I was going to slow me down. I was, every takeover was going to be nightmare, especially doing 2 or 3 properties at the same time that we were acquiring. Like it was is burdensome to be vertically integrated down to the property management level. So we decided to do third party
Mhm.
property management like other people do. And when I did that, I lost all line of sight and transparency into the buildings. Like
Mhm.
I didn't know what the hell was going on. I was getting hit left and right. Oh, we need this. Oh, we need that. Oh, we got to spend
Yeah.
money on this. Oh, and I was just like, okay, this is insane. How to seriously, people, there's got to be a better way. There's got to
Yeah.
be a better way to manage your assets. And sometimes you don't have a choice on property managers because some
Mhm.
of them won't work with you because they're too damn busy. And then some of them are you just in the markets you're in, there's a property
Yeah.
management crisis. And so you're having to deal with people that aren't the best at
Mhm.
property management. So how do you mitigate some of that from an asset management level, right? And
Yeah.
so that was the impetus to it. Actually, really what it was I was at a property. It was this
Mhm.
2020. And I happened to be talking with the property management staff, and I'm sitting in there, and the maintenance technician, this is early 2020,
Mhm.
and the maintenance technician had to they didn't get their work orders on a phone. They actually
Yep.
printed them off and put them in a little bin, and they had to come to the office, get their
Mhm.
work orders in paper, and then go out for the day, right? Then
Mhm.
they had 2 to 3 techs because it was so large, it was like 278 units or something.
Mhm.
And so I'm like, okay, first of all, that's stupid, but
Yeah.
okay, fine, whatever. And then, but he gets in there and he picks up the work order and he goes, I think I've worked on this dishwasher like a couple of
Mhm.
times. And I'm like, well, time out. How do we not know how many work orders have been on that dishwasher? Do we not
Yeah.
know? And everybody was like, I don't know. I don't get we
Mhm.
can't keep track of it, and there was no way to keep track of it in the property management system. And
Yeah.
I was like, whoa, time out. This is dumb. Like, what if we worked
Yeah.
on that thing 20 times in the last 2 years? Why have we not gotten rid of
You
it by
replace it. Yeah.
replace it, right?
Mhm.
But there
Yep.
was no way to keep track of it in the
Mhm.
property management system that they were using. And it's not like a small one. I mean,
Mhm.
I think Yardi just now kind of came out with this kind of
Mhm.
concept of tracking work orders to assets.
Yeah.
But not every property management system has that. It's like, okay, this is stupid.
Yeah.
We got to be able to keep track of what's on our building. So starting to solve that one little problem, then I
Mhm.
created my company. And so now we are it blew up. So now we're a digital twin platform. And what a digital twin is, it's a
Mhm.
virtual representation of an object in the real world. And
Mhm.
so there's digital twins of cars and digital twins of objects. So what we do is a digital twin of buildings down to a very, very granular level. Like what's the wall color? What kind of flooring's on there? What kind of HVAC system do you have? How old is it? What is it? Where is it? How old is it? Like,
Yeah.
what's its condition? Is it under warranty, not under warranty? But not only that, not on the building itself, but on the property. We'll locate your water cutoffs. Where's your sewer clean out? Where's your boiler pump room or your boiler
Yeah.
room? Where's the pool pump room? Where is everything? What is it? And then who's the manufacturer of it? Like everything. We'll go
Mhm.
capture all of this data. And then once you have that data, you're about 100 miles ahead. I mean,
Yeah.
like just as an owner, because now you can scenario plan. You don't need to go walk that unit. If you're doing a turn, just order the materials. You know what's in there. You don't have to go
Yeah.
walk it anymore, right? So there's a lot of benefits to having all this data in your system. And
Mhm.
so that's kind of the base product, but then we give you the ability to kind of keep it up to date.
Yeah.
So it's as you buy something, change something, get rid of something,
Yeah.
update something, you can do that in the system. And we have a whole inventory control feature around the supplies and all that other stuff, right? So
Wow.
you have this ability to kind of understand what's on your buildings and your property.
Mhm.
And then we aggregate on top of that the energy consumption and water consumption and gas consumption in real time.
Yeah.
The work order data from the PM system, the IoT device data if you have it, or the BIM system data, which is mostly on
Yeah.
office and industrial, and the supplier data. So
Yeah.
now you pull it all together and now you can go, oh, that's what the hell is going on in my buildings, right?
Mhm.
And
Yeah.
because if you don't pull it all together, you just don't know. So if
Yeah.
you have like, you can see, oh, this building is using more water than this building. Well, why?
Mhm.
Is it the toilets? Is it there's a leak? Is it, I
Mhm.
mean, there we got no leak sensors telling us there's a leak. So what's causing this issue? Is it something like that? Or is it, you want to do green improvements? Well, all the window types in there. So you can scenario go, oh, well, we changed it to this window type. We know how much
Mhm.
energy we can save, right?
Yeah.
So you can go, oh, what's the better bang for the buck? Is it insulation or is it windows or
Yeah.
whatever it may be? Because you know what's on your buildings.
Yeah.
Right. So that's kind of the system that we created. And we launched earlier this year. So it's really kind of early, but it's starting to have pretty cool things, starting to have good
Yeah.
results with it.
Yeah,
So
I mean, my mind, just a couple of things that I want to unpack there, just real quick. And oh my goodness, look at the time. We got to close up pretty soon. But wow, time flies when you're having fun.
it
But
does.
I was at a property yesterday, and the property manager, while we were there, just said, "Hey, we're gonna have to be replacing the sump pump soon."
Mhm.
And I looked at him. I said, "We replaced the sump pump in April." And he's like, "Oh yeah, we did." I'm like, "Yeah, we're not replacing that again." And
Yeah.
I mean, it's one of these things where it's if you're, relying
Uh-huh.
on your property manager's memory,
Yeah.
that doesn't always work well,
It doesn't.
But
It doesn't.
I remembered that one.
Yeah.
But yeah, I mean and then the other thing you mentioned, like scaling as well. I mean, right now, for a lot of reasons, our company is only doing one acquisition at a time because we don't have the systems in place to do multiple acquisitions at the same time. We're
Yeah.
building that right now, but if you want to get to the point to where you're doing multiple acquisitions at the same time, you've got to have a system in place. You've got to
That's,
have something that automates as much as possible. Otherwise, you're going to be stuck in that one acquisition at a time
yep.
phase. That's what we're trying to do. We're trying to turn the corner, and
Yeah.
it's right now it's all about automating as much as we can to turn
For
that corner.
sure. You
Yeah.
have to automate. You also have to, your investor relations and your equity chasing, it has to go 5x because
Hmm.
especially even if you're doing two at a time, because we did routinely. And there's a whole, and it just it changes the type of investor. That's why we went from syndications to a fund because it changes the type of investor that you chase also. And we went through that transition too, which that was
Hmm.
oh, that was fun. Not.
Yeah.
But learning all of that, like how you, I mean, you're gonna have transitions as you scale, generally from who's your investor to sometimes what kind of properties you're chasing and
Yeah.
learn and all those lessons learned around that. And then, whether you do property management or don't, you have to transition from, to
Hmm.
third party and learning all of those lessons there. There's a lot of transitions that you'll go through as you scale,
Yeah.
for sure. Yeah,
Yeah,
for sure.
absolutely. All right. As we wrap this up, two questions to end it. First one, if you had to give advice to somebody who's just starting out in the multifamily business, what would that advice be?
When I talk to brand new real estate investors, a lot of them ask me, what books do I read? And I'm like, that's the wrong question. Don't
Yeah.
ask that question. That's not what you want to do. I mean, yes, you want to read books, but the first question about is what groups should I be in? Like, who do I need to talk to? Who do I need to be networking with? Who are the
Yeah.
people that I need? Because that'll get you further faster. And it's all networking. It's just like in any business, it's all
Yeah.
networking. It's who you know, how they can help you, and who they know. Because you're not going to find the deals for first when you're a first-time real estate investor unless you know somebody. You're just not going to find them. Or if you do find them, they're all the crap deals that everybody else passed on. So, you know, and you're going to waste your time and spin your wheels chasing crappy deals. Find really good real estate groups to be in. And yeah, you can read the books while you're like whatever, but find the groups and learn a lot. And don't be like those, and this is maybe a personal trigger of mine, but be humble. Don't be those people that think they know more than they do, because you're just going to turn off the people that can help you. And this is a people business. So, you know, I mean, if you did one deal, good on you, but that's nothing. I mean, like at the end of the day, that's nothing. You know, if you wholesaled one deal, that's nothing.
Yep,
Like,
exactly.
you
Yeah.
know, and so stop bragging and learn, right? And
Yeah.
that's the best lesson. And you'll learn for years. I'm still learning. I
Yeah.
mean, you know, I mean, I switched to tech, obviously, so I have a big, huge learning curve there. But I'm always going to be a real estate investor. So there's no way I'm not going to be a real estate investor. So I'm just not actively pursuing it now. But you always have to have this humble kind of, I want to learn from you. It might not be that it's that they're more advanced than you, but they might know something in a certain specific area that you need to know, and they might be an expert in it. So you need to learn from them. So just, yeah, those are the things that I normally try to tell folks. So
Awesome. Yeah. And I wholeheartedly agree with that one. You know, people, learn from people. Books are awesome, but people can get you a lot further. All right. Last question. How can people learn more about you?
they can go to my website, which is my company, Facilimax, which is FACILIMAX.com. And then that's my company. And then if they're interested in the PropTech Council, that's just proptechcouncil.com.
Okay.
And yeah, and I'm on LinkedIn, so they can reach me out there. I'm very active on LinkedIn. So yeah, that's the best way to
I
get
think
me.
that's where we first connected is
Yeah.
LinkedIn.
Yeah.
LinkedIn is a great place to connect. So if you haven't, if you want to connect with Amy or me, LinkedIn, go to LinkedIn, find us. And actually, you know what? I'll make it easy for people. We're going to put a link to your websites in the show
Okay.
notes. And I'll put a
All right.
link to your LinkedIn profile as well
Sure.
in the show notes, so people can really, really quickly get in contact with you. So anyway, Amy, thank you so much for coming on the show today. Very much appreciate your time.
Yeah. Thanks for having me.